Here's the big lesson. When you invest in a property, do not invest in the property unless the rental income will give you a positive cash flow on the underlying debt. Because when I made that mistake, it was a blood bath for years, bloodbath, because the rental income that I could bring in did not cover the underlying debt. So be sure you run your math and your formula both on flipping, and if you got to rent it out, can you get a positive cash flow out of that underlying debt?
If you're a real estate investor and are wondering how to raise and leverage private money to make more profit on every deal, then you're in the right place. On Raising Private Money, we'll speak with new and seasoned investors to dissect their deals and extract the best tips and strategies to help you get the money, because the money comes first. Now here's your host, Jay Conner.
Welcome, everyone, to Investing for Generational Wealth. Let us dive into the world of expert financial insights and strategies. Before we begin, a quick disclaimer: we are not financial advisors. All investments are subject to risks, including the possible loss of the money you invest. So perform your due diligence before making any financial decisions. My partners here in crime and myself, we just like to dress up and talk on a podcast. So, of course, consult your CPA and your attorney and other professionals in your life, not us, before beginning investments. I'm your host, Keshav, Kolur, and I'm joined by my co-host, John Lai. And welcome to today's episode, Fire Your Banker, Alternatives to Bank Funds and Hard Money. And here with us today to speak on that topic is Jay Conner. Jay, thank you for being here with us today.
Absolutely. I'm excited to be here, and thank you so much for inviting me to come along to talk about my most passionate topic, that being private money, because after all, private money has had more of an impact on our real estate investing business than any other strategy over the past 23 years that we have employed.
We can't wait to get into it. So before we dive in, if you could just give us a quick background about your journey, how you got started, what it's looked like along the way and where you are now.
Sure. Well, my wife and I started investing in single family houses here in Eastern North Carolina all the way back in 2003. That's when we went full time. We're in a very, very small market. Our total target market's only got 40,000 people in it. But we do 2 to 3 deals a month in this small market. Our average profits now are $82,000 per deal, per profit per deal. And I don't share that to brag whatsoever. The reason I share that is to make a point, and that is you don't have to be in a huge, large market to make significant income. Case in point, our total market here is only 40,000 people. And there's a argument to be made that there's a big advantage to be in a smaller market, because I would much rather be a big fish in a small bowl or a small pond than being, a small fish in a big bowl. So you can really dominate your market. So I advise people, instead of investing right there in the big cities, go out there in the outer suburbs. Well, so we started in 2003, rehabbed over 500 houses here in our local area since that time. But the first 6 years that we were investing in single family houses, we relied on the local banks to fund our deals. That's all I knew to do. But then in January of 2009, things changed rather abruptly because there was a global financial crisis and the funding was like cut off overnight. So I lost my line of credit at the bank, and I knew I had to find a better and quicker way to fund my deals. Hence, that was the birth of private money in my world. And since that time, I've never missed out on a deal for not having the money. We've got 47 private lenders that are investing in our deals now. I was able to raise $2,150,000 that first 90 days of being cut off from the banks. But here's the point of that story. I've never asked anybody for money. When I was borrowing money from the banks to fund my deals, I had to do applications. I had to get on my hands and knees and beg and persuade and say, please fund my deal. But in this world, there's no begging, chasing, selling, persuading. There's no selling whatsoever. In fact, you're already approved in this world of private money. So how do I have all this private money, $8.5 million in private money available for our deals without ever asking? Here's the secret. What did I do? I put on my teacher hat, my private money teacher hat, and I started teaching people that I had some kind of connection with what private money is, how they can get high rates of return safely and securely, how they can use retirement funds to invest and be a passive real estate investor and earn money either tax deferred or tax free. So I just started sharing with people in my own network how they can become involved. And so it was all through teaching and educating that the money started chasing me instead of me chasing the money.
Okay, thank you for that introduction. So just getting into it, right off the bat, you mentioned private money as an alternative to your typical bank financing. When you say private money, do you mean private investors? Do you mean smaller banks? What do you mean exactly? Like, who are these people? Who are these entities? How do you find them?
Yeah, these private lenders are individuals. They're human beings just like you and just like me that use their investment capital and or their retirement funds to loan money to us, the real estate investor, as the borrower. So there's no middle person involved. There's no brokerage involved. It's a simple one-on-one transaction directly between you and the private lender. Now, you ask, where do you find these people? Well, there's three primary categories as to where you find private lenders. First is what I call your warm market, people that you already have connections with. Second category is what I call your expanded warm market. Where can you go in your local area to expand your network very, very quickly? I say the more money you wallow in, the more money sticks to you. So go where the money is, and I can tell you exactly where to go. And the third category of private lenders are existing private lenders. These are people that are already individuals that are already loaning money out to real estate investors. Well, where do you find those people? Well, when I started out all the way back in 2009 looking to raise private money, I hired my real estate attorney's paralegal to search public records in our local county, looking for individuals' names that were loaning money out secured by real estate. There was a deed of trust securing those notes. Well, in 90 days, we only found two people. I said, well, there's got to be a better and quicker way to find where these private lenders are. And so we started developing the private lender data feed, which the members in my world have access to. We update the data feed, this software, every month. We get every private lender's contact information that are loaning money out to other real estate investors. In addition to that, you can find existing private lenders at self-directed IRA networking events. So interestingly enough, over 70% of account holders that have an account at a self-directed IRA company, that's also known as a third-party custodian, want to loan money out to real estate investors. They want to be passive. And so, I've got a particular self-directed IRA company that I recommend to everybody that my private lenders use. I don't know if you guys have got one that you endorse or not, but that's where you can find a lot of private money very, very quickly as well. So again, through your own connections, people you go to church with, people in your cell phone, people you go to the Rotary Club with, who do you play golf with? Where do you go on a consistent basis that you see the same groups of people every week? Those are the people that you got the closest connections with. You got a close bond of trust, and people that trust you are going to be more likely to do business with you very, very quickly. So your own connections, where can you go to grow your connections? I can tell you where I've gotten a lot of private money, and that is I joined BNI, which stands for Business Networking International. Business Networking International is founded by Ivan Meisner decades ago. And what's beautiful about Business Networking International, you join that organization, your local group, And now all the other members in the group are promoting you and endorsing you. So you go join as the real estate investor and you tell people that you are paying high rates of return safely and securely to your private lenders. So you educate your fellow BNI members, and now they refer people to you that are not happy with their investments, that are looking for a more stable and higher rates of return. Those are the three main categories where you find private lenders.
Are your investors typically investing in a particular opportunity that you present, or have you already cultivated that relationship that they'll just lend you the money and then essentially await the opportunity once it's found?
That's a great question, John. So the private lender does not loan me directly the money. And in fact, no money comes directly to my company. So what they are doing until after closing. So all of the notes are backed by the real estate that we are buying. So for example, every real estate, every property that we buy, when a private lender funds that deal, or in fact, you can actually have a couple of private lenders, more than one or two, funding the same deal, they each get their own promissory note and their own deed of trust. In most states, it's called a mortgage. So we're not borrowing unsecured funds. We're borrowing secured funds. So the notes are backed by the real estate we're borrowing. The private lender wires their funds directly to my real estate attorney's trust account. Some states, it's a title company that handles the closing. But the funds are wired directly to the closing agent, title company, real estate attorney. We close on the real estate. And then when there are excess funds to close at, excess cash to close, then that excess cash then comes to me, and I'll use that for rehabbing the property or whatever. But that's a great question. The funds will go directly to the closing agent and do not come directly to me.
Have you ever looked at the funds of fund model where investors do invest in a fund, maybe not necessarily you again, but a fund which accrues in the event that there are, you do find these opportunities in the future, and then the funds are invested?
Yes. Typically, when people invest in a fund, typically that's going to be for a commercial property. Everything that we do with single family houses is what's called one-offs. One-offs. So you have a property funded by a private lender or one or two private lenders. And so they're investing directly in that property. In contrast to that, if you're doing, an apartment complex or a commercial property, self-storage, etc., then typically you would create a fund and you would an SEC attorney to draw up that private placement memorandum. And so then your private lenders and investors would invest in the fund. And depending on how the fund is created, they perhaps will get a return during the course of the transaction and the purchase and the remodeling, et cetera. And then they may get a percentage of the equity and profit on the back end of the deal. With these one-offs with single family houses, the private lender is getting an interest rate, and that's it. They know exactly what their interest rate's going to be. I pay 8% right now, no points. They get 8%, and there's no joint venturing. There's no participation in the equity on the back end. It's a very, very simple one-off transaction.
Got it. Thank you.
How did you fare? How did the private lending business fare, or private credit in general, when interest rates have been super low these past, not now, obviously, but, before that, right? Because why would someone invest into a note, what maybe the rates were like, I don't know, 6% or 5%, but the stock market was on a tear, real estate equity was on a tear, etc.
Sure, great question. Well, so one question I get similar to that is, well, Jay, prior to COVID, the 12-month certificate of deposit at the local bank got down to an average of 0.17% annual yield in a 12-month CD. Today, you can get a 12-month CD at 4.5%. And they'll say, Jay, why aren't you paying your private lenders more money today than you were back, 4 years ago? And why are they happy with that? Well, it's real simple. Number one, I make the rules, not the lender. You see, when I was borrowing money from the banks, who made the rules? The bank made the rules, right? The hard money lender. By the way, we're not talking hard money here. This is not hard money. Hard money is typically loaned to you from a brokerage or a hard money lender that's going out and raised private money for their fund, and then they loan that out. That's not this world. We're doing a direct transaction between us, the borrower, and the individual private lender. So how is it? I mean, I've been paying 8% ever since 2009. 8%, same deal, same program. I don't care what the market's doing. And I say, Jay, how can you pay the same thing when the markets are fluctuating? Well, here's the two answers. As I said, number one, it's my program. I make the rules. Number two, 8% is still a whole lot more money than 4% or 4.5%. And it's backed by real estate, and it's a conservative loan to value. We don't borrow more than 75% of the after repaired value of a property. So all the private lenders are happy. They're making a lot more money than they can still make in a traditional investment at the local bank. And they're protected. We're not borrowing unsecured funds. In fact, we also named the private lender on the insurance policy as the mortgagee. That way, if there's any claim against that insurance policy on that property, then guess what? Insurance company makes the check payable not only to my company that holds the investment, but that check's also made payable to the private lender. They're named as a mortgagee. That gives them a layer of protection. They got to sign off on the check before I can get it. We also name them on the title policy as an additional insured in case there's any title issues down the road. And I pay all the private lenders the same. You know why? Because private lenders talk. And if I pay them all the same, I don't have to remember who I paid what. It's all the same program.
So just a reminder, if you have a question, submit your questions in the Q&A box. I don't believe our chat box works right now, but Q&A box, please submit your questions there.
Chat box does work, I think. I don't know. I guess we'll see.
Chat box does work.
Yeah,
okay.
Yeah, we're good. Yeah, the chat box or the Q&A, and we'll answer them as they come in. What
do you have any gotchas? Oh, sorry. I was going to ask, do you have any gotchas, Jay, that best practices or things to watch out for?
Well, best practices as far as me running the real estate investing company, or best practices for the private lender?
For both, really. If you were the private lender, investor, what to watch out for, and then as an investment company as well.
Sure. So let's start with the private lender. So really the private lender is not investing in that property. The private lender really is not investing in that deal. The private lender is investing in you. The private lender is putting their trust, even though they're being protected, even though they've got the mortgage, they got the, all these layers of protection. They're investing in you, the operator, that you know what you're doing. And so since they're investing in you, you better know what you're doing. Right? I mean, you need to know what's the maximum that you should be offering on a property, and you should have the formula for that, because it's the math that makes the decision, not your head and not your heart and not your emotions. So the math makes the decision. Do you know how to estimate repairs if repairs are needed on a property? Do you have a good relationship with a general contractor? Do you have a good relationship with a real estate attorney? Do you have a good relationship with a realtor if you're not a realtor yourself? So you want to make sure the team is in place. I mean, the worst time to be looking for a private lender is when you need one for a deal. That's why I practice and preach the money comes first. I tell you what, guys, I know you all have heard it, and it drives me stupid crazy. These people going around saying, oh, just get the deal under contract. Just get the deal under contract. The money will show up. Have you ever heard that?
Yeah.
Of course you've heard it. You've heard it 1,000 times. Just get the deal under contract. The money will show up. And I want to say, baloney. Where's the money going to come from? Is it like going to rain out of the cloud or something? I mean, I just don't want to put a deal under contract, and I don't know where the money's coming from. But think about how much more confident, how many more offers you're going to make on properties when you got the money burning a hole in your back pocket waiting for you to put an offer on it. Anyway, excuse my rant. But back to your question, best practices. So from the standpoint of the real estate investor, when word gets out that you're paying high rates of return safely and securely, like myself, you're going to have money chasing you very quickly. That's one reason I never have to ask for money. I mean, you start doing a couple of deals and the word's going to get around. And so you'll have people asking you questions such as, well, how do I get started as a private lender? I mean, what do I do? Just write you a check? And of course, the answer is no, they don't write you a check. You got to protect your private lenders, because here's the deal. All 47 of our private lenders that are investing in our deals right now, not one of them, not one, had ever heard of private money and what it was until I put on my teacher hat and I started teaching them what private money is. Not one of our 47 private lenders had ever heard of self-directed IRAs and how they can use their retirement funds and move them over to an IRS-approved self-directed IRA company and loan that money out from their retirement funds and earn tax-deferred, or, depending on the type of retirement account they've got, or tax-free, unlimited money per year. Imagine tax-free. That works if you've got a Roth IRA. So I simply taught people in my own network how they can do this. So with that in mind, you as the real estate entrepreneur, you got to look after your private lenders, those that you've taught and opened this up to. I mean, I raised $969,000 at one private lender luncheon, one, where I just invited people to come to the luncheon and I fed them lunch and I taught them my private lending program, how they can get involved and earn high rates of return safely and securely. But since they've never done it, you got to protect them with these different things in place that I'm talking about.
What else would you recommend they look out for in addition to making sure they're investing with the right person? Is there underwriting they should ask for, like pro formas, anything like market reports, anything like that?
No, I don't even have a credibility kit. I am my credibility, right? People talk about these credibility kits. If you need a credibility kit, you need to go work on your own credibility, for goodness sakes. So the thing of it is I'm not looking to do business with people I don't know, right? I'm looking to do business with people that I know and that I've grown my own connections and my own network. I mean, you guys have heard it 1,000 times, is the direct correlation between your network and your net worth, right? So what are you doing to nurture your network and to grow your network? If you're not connected, if you're not well connected or if you're not networking and you've got those business connections, then it's going to be very difficult for you to raise private money. Now, it wouldn't be difficult for you to get hard money. I mean, hard money is from a broker, but you're not going to pay 8% to a hard money lender. In fact, maybe you can't even get approved in today's market with a hard money lender. You got to have a 700 credit score or better. You got to have a long track record of experience. And you're still going to be paying, depending on your experience, depending on the relationship, you're still going to be paying 12% to 14%. And you're going to be paying points on top of that. And you're going to be paying junk fees on top of that. And you're only going to borrow typically 65 to 80% of the purchase price, and you're going to have to bring a large down payment. So you can get the money if you've got the credit score and you've got the experience without a large network. But your life is going to be a lot happier with you making the rules and doing business with your own network.
So you mentioned that your private lenders come up to usually 75% of the capital stack. So where does the remaining 25% come from? Is that directly from you? Do you have equity investors also?
I didn't say 75% of purchase price. I
Oh,
said
ARV.
75% of the after repaired value. So, for example, that's why I always bring home a big check. So I get 100% of purchase and I get 100% of rehab. So let me give you just a real simple example. And I'm going to use small numbers that would not apply in North Carolina. So let's say I'm buying a house, a property with an after repaired value of $200,000. And let's say it needs a rehab of $30,000, right? Not a major rehab, $30,000 rehab to turn it into a beautiful home. Well, on those type of properties, I buy them all day long at 50% of the after repaired value. So I'll buy that house for $100,000 in its current condition. And so I buy it for 100. Well, I can borrow up to 75% of the after repaired value. Well, the after repaired value is 200,000. So I can borrow up to $150,000 because that's 75% of 200,000. Well, if I'm buying it for $100,000 and the private lender is going to wire $150,000 to the closing agent, that's $50,000 in excess cash to close, because the closing agent's going to take 100,000 of that 150 and pay the seller, because I'm buying it for 100. Well, 150,000 was wired into the trust account. Well, that's an overage of $50,000. Of course, less a little bit of money for closing costs. So after closing, I'm going to get a check for close to $50,000 because that's excess cash to close. By the way, that's the exact phrase on my real estate attorney's check stub. I love me some excess cash, right? So I got a $50,000 excess cash to close. Well, I'm going to take $30,000 of that $50,000 check to do the rehab. Well, it always costs more than you think it will. So maybe I'm going to use 35,000 of that 50,000. Well, that other 15,000 I can use any way I want to. That's what you call just pulling equity, out of a property. And then when I go to cash out, I sell it for $200,000 through my realtor. I still owe my private lender $150,000 because I'm paying or accruing interest only. So I'll sell it for $200,000, pay realtor fees, and pay off the private lender the principal loan amount of $150,000, plus, of course, any unpaid accrued interest. That's how I bring home a big check when I buy. So here's a check and balance. Here's a check and balance. When you're paying all cash with private money to buy a single family house, if you can't bring home a check when you buy, you should not do the deal. There's your check by using the formula that I'm sharing. Borrow up to 75% of the after repaired value. You buy it. You should be able to bring home a check when you purchase. And if you can't, you paid too much for it.
I was going to ask earlier, do you find that because you're paying 8%, most of the private money lenders basically are allocating their portfolio as if instead of investing in bonds or really risk averse instruments, they're investing in you?
Yes. And I've got private lenders. Some private lenders only have $50,000 with us. Some private lenders have $1 million with us. And of course, the private lenders that have $1 million with us, that $1 million is spread over different properties. We might use $250,000 on this property, $300,000 on another property, $150,000 on another property. And each of those loans have their own notes and their own deed of trust securing each note by that property that we purchased.
Got it. Okay. My other question with regard to sources of investments is, kind of the tax component of it. Self-directed IRA certainly has potentially a tax component, tax savings component. What are some other like tax strategies that private money investors can take advantage of?
Yeah, you bring up a good point, John. That's really the only one that I'm aware of. So a self-directed IRA, if they're using those retirement funds, depending on the type of retirement account they have in the self-directed IRA, it's either going to be tax deferred or it's going to be tax free, depending on the type of retirement account they have. If the private lender is using investment capital and was just liquid funds that they would be investing in the stock market or mutual funds or treasuries or whatever, then they are going to pay taxes on that income, just like they pay taxes on dividends that they earn off of stocks or whatever. So whatever tax, so it's ordinary income. So if they're just using liquid investment capital instead of having it in the stock market, then at the end of the year, they're going to receive a 1099-INT, which stands for interest, 1099 interest. And so whatever their ordinary income tax bracket is, they would pay taxes on the interest that they earned.
Got it. Okay, perfect.
From the investment company's perspective, when you're raising funds from private lenders, in addition to the terms of the loan and obviously working with people that you know, like, and trust, and making sure the math checks out, like you said, the ARV value and all that stuff, what else would you recommend, if anything, to keep an eye out for?
So one thing that I like to do is when they're using investment capital to invest in our deals, I give the private lenders in the promissory note in writing, I give them what's called a 90-day call option. 90-day call option. So for any reason whatsoever, if they have an emergency come up or they just want their money. They want to go on a vacation and they want some money. So all they have to do is just give us notice that they want to call the note due early. Now, the notes we put in place are typically 2 years. I typically don't use the money for 2 years, but we set the term up for 2 years. If they want the money back early, of course, when I cash out on the property, they get cashed out. When I sell I can't keep the money. I can't keep the money. I'm going to keep that money secured by a property. Well, clearly, if I've sold the property, it's not my property. I can't secure the note anymore with that property. Excuse me. So when I sell, they're cashed out. But if they need the back prior to the note coming due or me cashing out, in the promissory note, there is a 90-day call option. So all they've got to do is give me a 90-day notice that they want to cash out, get their money back, their principal loan amount back, along with any unpaid accrued interest. That gives me plenty of time to replace their private money with another private lender. All I've got to do, I don't even have to go to another closing. I can take their note and I can sell their note to another private lender. And we don't even have to refinance the property. So and my private lenders enjoy that. Now, I typically don't give that if they're using retirement funds, because the likelihood of them calling a note due early and its retirement funds are very, very slim, because they're going to have to pay a penalty if they call that note due early and cash it out. So they like that. Another thing that we put in the promissory note is we give what's called a minimum of 6 months of interest. So in the unlikely event that we buy a property using the private lender's money and cash out and flip it in less than 6 months, that hardly ever happens. But in case it did happen, in the note, I'm going to pay them at least 6 months of interest on that note, or unless I've got another property I'm buying immediately, or got another property that I've got equity in that I'm rehabbing. We do a lot of substitutions of collateral, also known as a loan modification. So the way the substitution of collateral works is on smaller amounts of money. Let's say they've got $50,000 on a note in second position, and we use that money for the rehab. Well, in that case, if I cash out and sell and they want to keep their note in play and keep earning money on their money, then I can substitute the collateral. My real estate attorney handles this for me. We keep the note open and then just move the collateral that is collateralizing that note.
Is it pretty easy for your investors to reinvest, or do you have some sort of minimum, like, hey, you have to reinvest, at least $50,000, or, if they make a couple $1,000s, can that go in?
Yeah. So when we're doing a new note and writing a new note, my minimum is $50,000. And here's why. I got to pay my real estate attorney the same $450, whether I'm doing a $5,000 note or I'm doing a $500,000 note. So it just doesn't make sense to take smaller $5,000, $10,000, because that's not unsecured money. That's being secured by the property. Therefore, the real estate attorney's got to draw up the documentation, and everything is recorded on public record, so everybody's protected.
And you mentioned that each of these flips usually, on average, nets you around $80,000 in the market that you're in, and that you do 2 to 3 a year, I believe.
2 to 3 a month.
2 to 3 a month. Okay. All of that, the earnings that you make, does that go back into flipping more properties? What is your investment strategy for keeping the money that you do earn, keeping it growing and moving?
Yeah. So the money that I earn, I have other investments that I invest in addition to single family houses. I've built shopping centers from the ground up. I've done condominium developments. I've done townhomes, and boat docks. So I like to diversify. But most of my business is investing in single family houses.
Do you ever have a buy box, not so much for the properties you flip, as much as your investors? Like, they have to fit a certain profile, or are there any I guess profiles you try to stay away from?
That's a great question, John, because our 47 private lenders, what they look like is very, very different. They're all over the board. I mean, we've got retired entrepreneurs that were in business for themselves for years, and they are private lenders with us. We've got retired teachers that worked, in fact, more than one or two of them that worked in the public school system using their retirement funds that they built up over the years. We've got people that were in civil service for decades, like 30 years, and they're using their retirement funds. And I've had minor children under 18 years old as private lenders because they inherited money from grandmother and granddaddy, and the parents wanted them to use that investment or use that money wisely. So I've actually had minors. So don't rule out anybody. However, people ask me all the time, well, Jay, where do I start looking? I mean, where do I start looking to find these private lenders? I can tell you a great place to start. Make a list of the people in your cell phone that are retired. Make a list of the people in your cell phone that are retired. Why is that? Because there's a good chance they got retirement funds. And I can tell you, if they've got retirement funds in this market, they probably are not happy with the volatility of the stock market. And the older they get, the less likely they're going to live long enough to live through another correction. And is another correction coming? You better believe another correction is coming. And so the older the private lenders are, the more important it is for them to get a steady, reliable, confident rate of return on their investment.
I really feel like we hit everything there, unless there's something that you wanted to cover, Jay, that you want our audience to know.
Absolutely. There's one more thing I want to cover, and that is, if you are here and you've been enjoying this conversation, you found it inspiring and enlightening, then I want to invite you on over to my brand new privatemoneychallenge.com, privatemoneychallenge.com. It's a 7-day private money challenge. You get a video every morning of me. I just recorded them. They're only 15 to 20 minutes long, but it's chock full of content and education on really the details of getting all the private money that you would want. So come join me in the 7-day private money challenge at www.privatemoneychallenge.com, and I'll see you on the inside. In addition to that, I have a podcast with almost 700 episodes right now. I have amazing guests on there, and I interview them on how they've raised private money. And the name of that podcast is, believe it or not, Raising Private Money. Raising Private Money with Jay Connor is the name of the podcast. You can find it on all of your favorite podcast platforms. We go 2 episodes a week. We release them on early Monday mornings and Thursday mornings. Come check me out at the podcast, Raising Private Money with Jay Connor.
Thanks so much, Jay. So go ahead.
I was going to say, that's pretty impressive. 2 podcasts a week. That's pretty amazing.
Absolutely. Well, I got to say, you can't do 700 podcast episodes unless you really enjoy doing it.
Right.
Well, thank you guys so much for having me here on the show.
Well, real quick before you head out, we do have the 3 questions that we usually like to ask our guests to wrap up every interview.
Oh, I don't know if I can handle this.
The first question is, describe some of the failures that you've had and what you learned from those failures. We'll talk about the biggest private lending business specifically.
Yeah, one of the biggest failures and mistakes that I made early on is I bought a property over on the beach. We're here in a resort area, and I bought the property with the intention to flip it. Well, by the time I bought it, rehabbed it, put it on the market to sell, the market had started coming down. I did not adjust my price, and I ended up being stuck with that property and had to put it on the rental market. Here's the big lesson. When you invest in a property, do not invest in the property unless the rental income will give you a positive cash flow on the underlying debt. Because when I made that mistake, it was a blood bath for years, bloodbath, because the rental income that I could bring in did not cover the underlying debt. So be sure you run your math and your formula both on flipping, and if you got to rent it out, can you get a positive cash flow out of that underlying debt?
Do you ever, I was going to say, as an adjunct to that, do you ever look at not necessarily flipping properties, but keeping properties?
Oh, absolutely. So when I buy with private money, pay all cash, I cash out because I don't want private money buried in a property. However, when I buy a property on terms, i.e., I could buy it subject to the existing note, I can buy it with seller financing. So if I've got some kind of creative terms that the seller will sell to me creatively, then I'll sell it on terms, lease purchase or rent to own. I love selling on lease purchase and rent to own because those tenants do not have the mindset of a traditional renter. They've got the mindset of an owner. So after 30 days, they are responsible for the repairs, not me. And I'm going to collect a large non-refundable lease option deposit when I sell it. So those I'm holding until they get ready for a mortgage to cash me out. I don't like being a straight renter because I don't like paying property managers and I don't like tenants and toilets, but I love selling on lease purchase.
All right, second question is, what advice would you go back to give your 10, 20-year younger self?
Don't start in this business by yourself. Don't start in real estate investing without working with somebody that's got the experience. Yeah, I mean, you're going to pay for your education one way or the other, and don't pay for it the way I did with stupid mistakes that cost me hundreds of thousands of dollars. Get yourself a good coach or mentor or someone locally that knows this business. Work with them first. Don't try to figure it out on your own. Bad mistake. Ask me how I know.
And lastly, if you could just rattle off again the best way for our audience to reach you.
Sure. So obviously in the privatemoneychallenge.com will be my contact information. And to reach out to me, of course, you can just go to my website, which is www.jayconner.com, JayConner.com. I'm not an OR. Most Connors are ORs. I'm an ER. So www.jayconner.com. And we've got a really, really novel thing going on here at our office. When you call our office, we actually answer the phone. Can you imagine that? Somebody actually answers the phone when you call. So, yes, I'm here to serve your audience any way that I can.
Sounds good. Well, thank you very much for a great chat, Jay. To learn more about Fire Your Banker, alternatives to bank funds and hard money, feel free to reach out to Jay at the methods he just mentioned, his website or two websites. We'll also include his contact information in the description for this podcast episode as well. And again, Jay, thank you for taking the time out of your busy schedule to speak to our audience.
Thank you so much.
Thanks, Jay.
For those of you listening at home, don't forget to like and subscribe to our podcast on whatever platform you're listening to make sure that we can continue bringing you the best educational content. Thanks, everyone. And until next time, keep learning to invest for generational wealth.
Are you feeling inspired by the knowledge you gained in this episode? Then head over to jayconner.com/moneyguide. That's jayconner.com/moneyguide and download your free guide that shares 7 reasons why private money will skyrocket your real estate investing business right now. Again, that's jayconner.com/moneyguide to get your free guide. We'll see you next time on Raising Private Money with Jay Conner.